pull up the blue book? So tell me when you're ready. Yes, sir.
Is this for the midterm
This is the blue book.
packet?
Yeah, and you can, yeah, exactly. And then the one I just handed, you can just fill it in. And you don't need a blue book, you just fill it in. And you can put the take-home exam in the blue book. Okay. All right. All right. So let's go through so to build the optimization model, I needed to build a forecast model for total returns for the individual markets. Just like you would do if you were going to build a forecast model for the stock returns. But I'm not making you do that. Okay. But you would have to build what would be the number one factor that would drive, or give me two factors that would drive stock returns. If you were going to build a multi-factor model, either a regression model or an APT model, what would be, give me 2, 3 factors that you would put in the model to forecast expected returns on the stock.
Interest rates?
Yeah, exactly.
Inflation.
Inflation expectations will already be embedded in the interest rates, but you could, if it was a inflation-sensitive sector that you were trying to forecast the company, then you probably put it in as a factor. Okay. Any other factors? We're missing one really important one.
EPS.
Yeah, exactly. Earnings per share. You know, or free cash flow per share, or EBITDA. Exactly. Any other factors? Maybe a leverage, maybe debt to equity or debt to total market cap. That would probably have an effect on the returns. Maybe projected sales or some other factors. So what we needed to do is we needed to create a forecast model to be able to forecast expected returns for the individual markets, individual metro markets. So the first was a multi-factor model. These are macro factors. So this could be considered an arbitrage pricing theory type of model, mostly macro factors that drive these things. They could be micro factors too, but this is really a macro factor. So we did back test the return series, and we found out that the multi-factor model is better than the single factor model. So we added supply factors in there, and you can see the green is nice and tight around the red. So you know that it does a good job of forecasting. So we felt pretty confident being able to forecast the returns. Then we took those factors and we basically ran the regressions for the individual markets, and then was able to forecast the dependent variable, which is the apartment returns. So we had employment, we had populations between 25 and 44 years old, that's the renter cohort. We had multifamily permits, and we had affordability, which is another proxy for supply, right? Because in these markets, if you have high affordability, then you're going to get low demand for apartments because people are going to want to live in a house as opposed to live in an apartment building. But if you have low affordability, that's really going to drive the returns in those markets. So the supply-constrained markets, when you looked at the T statistics, they were pretty significant for the affordability as a supply factor. So 2 supply factors, 2 demand factors. Okay, not a lot of multi-linearity in the model. Then we looked at the ability of the model to forecast and basically ranking the returns against vacancies and occupancies and other market factors, and the rankings turned out to be pretty good. So again, just another confirmation. And then looking at these rankings over time, compared to the other factors, you can see that there was a very tight band around those rankings. So again, another confirmation of the ability of the forecast model to forecast returns. Then we set up the parameters, the minimum, maximum constraints in the portfolio, the target returns. Since we had the historical returns for the 14 metros, we were able to calculate the covariance matrix and use the forecast model to forecast out the expected returns. And then we were able to run the optimization procedure. And the optimization procedure then kicked out the weights of the portfolio using the active approach, the Markowitz optimization procedure. Also setting the constraints. So we used also an economic base model to look at where we were over and under concentrated by economic base, because you can diversify geographically, but if I'm investing all my money in Cambridge, Massachusetts, Santa Clara County, San Diego County, I'm getting, and maybe Eastside Seattle, I'm getting very high concentration of tech. I'm getting diversification geographically, but I'm concentrated in the same industry. So that, that doesn't make sense. Then what we did was we did a passive approach, where I basically found occupied units for apartments for each one of these metros, multiplied it by the effective rent to get the total operating revenue. I also found an expense ratio, multiplied the expense ratio by the operating revenue to get the expenses. Revenues minus expenses gives you NOI. Once we get the NOI, we sum it up, divide them back. Here's the passive approach and the passive weights for management to target. Then what we did was we looked at the expected weights across the geography, our active approach and passive approach, and then calculated the variances. And very quickly we were able to identify that we were severely underweighted in Southern California and Northern California. And eventually, based on the other models, we sold off all the other markets and redeployed the capital into these two markets and started to develop new product and go further out the efficient frontier. The shareholders are willing to take on more risk if they were going to be compensated with more return. So we told them clearly that we were going to overcompensate in these two markets because they had the best fundamentals, not only historically, but we were projecting a very solid market performance going forward.
Is there any concern with being so heavily invested in one state?
Yeah, actually we were concerned about it, but we rationalized it and we justified it based off of performance. Because California had major geographic attributes that couldn't be replaced in any other state. I mean, we had ports of LA, Long Beach, we had Hollywood, down in Southern California, we had the beaches. I mean, a lot of places don't have that. And then you had tech, and you had the UC system, Stanford does in Northern California with venture capital. It's not, you can't replicate that anyplace else. So we felt comfortable basically doubling down and becoming more concentrated within the Pacific Northwest and along the coasts in California. And we looked at going up into other states, and we looked at going even on a national basis, but the performance and the justification, I couldn't make an argument for it, so we didn't do it. Okay. So here we have the target allocation. We have our target portfolio size. If you multiply the percentages by the total amount that we want to target in NOI, we can get the NOIs that we need to invest in those markets. You can divide the NOIs by the cap rates to get the values, the NAV values. You can divide the NAV values by the development cost or price per square foot to get the number of units that you're underallocated. And we divided the number of units by 250 because that was the standard product size that we developed at the institutional level. So it became very obvious very quickly to the board that we needed to probably invest about $1 billion in Southern California, and we should start to invest more heavily in Southern California. And since there really was not that much scale or production in these other markets, and because they never performed, we just made the recommendation, let's liquidate these markets and then redeploy the capital in the Bay Area and Southern California because they had the best long-term underlying fundamentals. And the market bought it. We were growing at about 20 to 30% per year for 4 years. It was very rapid. We went from like $1 billion to $3 billion, in about 5 years, okay, which is not a lot from the tech industry, but is a lot in the real estate industry. So once you built the portfolio, you have to start tracking it. And here are the tracking devices. So these were basically the dashboards that were developed so that senior level management could monitor the performance of the market. And these reports were published on a quarterly basis. There was not only metro level reports to track the performance of the markets, but there was also sub-market granulated property level reports, where we basically looked at underlying fundamentals within the individual property level, so really a micro analysis. And these were produced biannually, and then the quarterly reports were done on a quarterly basis. Then what we did was we designed a portfolio performance report, where we basically look at occupancy rates and rental growth rates, and calculated the variances between the actuals, the benchmark, a static number, and an updated market. Now here's the roughly 30, maybe a little bit more, 30 data points in here. And so what we were looking for was positive variances of the 30. So if you go up here and you look at our occupancy and rent growth performance, we actually beat the metrics in regards to occupancy. 99% of the sample we beat in regards to occupancy. So we were really good at managing the portfolio. And then we were about 60% positive variances on the rent side. So this allowed us on a monthly basis to basically track the performance of the portfolio and be able to identify very quickly where the variances were, where we were underperforming either by occupancy or rent growth. So it was another great tracking device. And then over time, every single year, we would do a hold sell analysis, just like you would do with your stocks or your bonds. You got to reevaluate the stock every now and then, run the fundamentals, run the technicals, and then basically decide, do I want to keep the stock in my portfolio, or do I want to exit? Do I want to sell it? We did the same thing with apartments. Every single year, we would basically re-underwrite every single property within our portfolio as though we were buying it for the first time to see if we wanted to keep it. And we would be, and at some point, if the rate of increase in the net present value over time as we're doing the evaluations, we're calculating the percentage change in the net present value every single year. And once the percentage change in the net present value equals the discount rate, that's the point in which you sell the property. So the point in which the net present value growth rate equals the discount rate, that's the point in which you sell the property, okay? Or what we would do is we would reevaluate the property and say, okay, well, what if we put in $10 million of capital, reposition, remodel, redevelop the property? The location's awesome, but the property's just 20, 30 years old. So why don't we re-underwrite it as though we're gonna redevelop it, remodel it, reposition it, and see how much IRR we can get over our WACC. And we would do that too. And a lot of our properties were in great locations. It was just the property was tired and needed to be repositioned in the marketplace.
Sorry, could you repeat what you said when the NPV growth rate equals?
The discount rate.
Discount rate.
Yeah, that's the point in which you would sell.
Okay.
And you always want to have an exit strategy so that you're rules-based. It's just like your trading models. It's a rules-based system. Okay, you have to have rules. If the rules basically say you need to exit and sell the asset, then you exit and sell the asset. If the rules-based system and the metrics tell you that you should keep the asset, then you keep it. If you need to reposition it, you reposition it. You don't put gut feel or feelings into it. And a lot of these developers and a lot of the asset managers become emotionally attached to their properties. Real estate is a physical asset. It's not like a stock and bond, which is intangible. We're talking about an actual tangible asset with architecture and aesthetics. Okay, and people interact with it. So you're going to be always comparing IRRs, cap rates, net present values, replacement costs, looking for opportunities to sell the property if you can. Next is the postmodern piece. The challenge was to develop a pure price commercial real estate index based on closed transactions at the national, regional, and sector level to provide industry with tradable indices used to trade commercial real estate-backed derivative products and control for data spikes while allowing indices to reflect the underlying real estate investment in space market fundamentals. So these were the objectives. So what we did, it took us about 4 months to design the methodology, and it took us another 8 months to actually build the data processing platform with all the algorithms. And we came up with 4 or 10 property indexes, a national, 4 property sector indexes, and 5 geographic regions. And then actually these could then be broken out into metro groupings, cities, counties. It was a data analytics solution that allowed us to scale out the data analytics platform to build custom property derivatives for clients who are looking for custom indices. A lot of the stuff now is all pretty much being done in the ETF market, but we were probably, I don't know, 3 to 5 years ahead of everybody before ETFs really took off. So here was the methodology that we needed to do to build these indexes. One, we had to figure out the property sectors, and we had to figure out the size of the markets. We had to test the data for normality, and we had to set up data filters to start cleaning up the data. Then we had to identify the algorithms to do the index calculation. Then we had to conduct back testing and analysis to show that the indexes actually do track the commercial real estate markets. And then we had to look to Wall Street and the Chicago Merc to basically design the exchange-based over-the-counter derivative products, and then how do you apply these derivatives as portfolio insurance for institutional investors that are holding huge portfolios of REIT securities, commercial mortgage-backed securities, and a lot of them actually held their own single accounts where they had billions of dollars in actual properties within their own single account. That's like CalPERS and CalSTRS. So the transaction data, we were able to pull data we bought data from appraisers, we bought them from data publishers, we pulled it from as many sources as we could and built a data warehouse out of it with all the factors. Commercial real estate transactions are very thin. They're nothing like the hundreds of thousands of transactions that occur in the single-family housing market. So we were running into basically sampling problems, because we just didn't get enough samples. So we had to group the metro areas to be able to pull the data to get the sample sizes large enough. And what's interesting is these metro groups, the distributions of the price data were fairly normal, and the distributions within these different geographic groups were very similar to each other. So it made the data fairly homogeneous and fairly normal, which was great because then we could get to mean variance very quickly. Then what we did was we coded all of the data, so every single transaction that came through the system was coded, all the way down to the zip code level, the property type or the classification of the quality of the building, and then the geographic location, and the property sector, property type, geographic location. And these were the sectors that we had identified. This is just the industrial. So again, we had historical data amongst these property types or classes, and then these basically we would sum up all of the square footage within each one of these classes, sum it up and divide it back, and that became the weights. Once we got the average price per square feet for each one of these stratas. So we segmented the market, we did market segmentation, market stratification. The data processing was pretty intensive. We collected around 5,000 transactions, and then data processed them over a 2-week period. But we were constantly collecting data, and then this is the data set that we used to calculate the indexes. And then we had basically 2 weeks to validate and verify all of the data to make sure it was correct. And then we sent it a week early to the Standard & Poor's out of New York, to the publisher. They ran their numbers on their side to validate the numbers and make sure that they were correct. What we did was we filtered the data. We logged all of the sales prices per square foot to get a normal distribution. I took, what was I using? 2 standard deviation filters. So then I threw out the data within the two standard deviations. And then actually we had a data verification arm too, where the data sets, data that was thrown out, if they were duplicates, we threw them out. And then we did some research on the data to see if some of those outliers were actual transactions, and if they were, we threw them back into the bucket. But we used the data filtering process to eliminate the outliers. Now, the index methodology is just like the S&P 500, because S&P basically gave us the methodology. So what we did was we took the weighted average prices per square foot for each of the individual sectors, multiplied it by the inventory to get the aggregate value. And then we divided the aggregate value by the base period divisor, and then multiplied it by 100 to get the index. So here's how we could break up the methodologies. So I had apartments. Here's the aggregate values. Basically, I could just add them all up to get the national. Add up all the aggregate values for the apartments and get the apartment index, office, retail, and warehouse. And these were market cap weighted, just like the S&P 500. Okay. It's the same methodology. And then we did the stratified weights, which we talked about before, where you add up all the square footage, let's say in industrial, class A, you do it for all of them, sum them up, divide it back, you get the weights, you get the price per square feet, calculate the weighted average price per square feet, and then multiply it by the inventory to get the aggregate value. Now the problem here, and this is the innovation, this is what you probably want to pay attention to this, because this was one of the innovations that I thought was pretty amazing. What would happen is we would run on a monthly basis. Sometimes we would not have enough data to calculate the weighted average price per square feet. We didn't have enough transactions. So what we did was we estimated a N, which was the minimum sample size that we needed. In the equation, this is called the precision equation, where you basically take the t statistic times the standard deviation, divided by a distance formula times a price per square foot. So what this did is if your sample sizes came in too low, what we did was we took the 3-month average in the prior period and brought it over into the current period until the sample size was big enough, and then we calculated the price per square foot. So if the index ever got really volatile, the carryover procedure would damp down the volatility. If we didn't have enough samples, we'd go back in time, replicate them into the future to get the sample size high enough to calculate a true mean. So that was a pretty cool feature of the index. And then here's the data processing procedure. So we get the 5,000 transactions, we get that dumped on a monthly basis. We would geocode everything. We would do check for validation, verification. We would code all of the transactions by quality class. We would process the data. We would do quality control checks, validation, verification on the data to make. We would do random sampling of the data and verify that the transactions were correct. Then we did the filtering process. We grouped and pulled the data by metro area. We applied the precision calculation in cases where there wasn't enough data. We carried forward the price. We calculated the mean price per square foot times the stratified weights to get the sector weighted average price per square foot times the stock or the inventory to get the aggregate value divided by the divisor multiplied by 100 to get the index. So the question was, what did these look like in indexes? I don't know, you tell me, do those look like indexes? Indexes aren't flat. Indexes have to have a certain amount of noise in them for tradability, because the derivatives traders down on the Chicago Mercantile Exchange and the pit, we're not gonna trade these things if there wasn't enough volatility, and if there's too much volatility, the institutional investors wouldn't buy the property derivatives. So what I did was I went back and I basically looked at the year-over-year change in all of the indexes, and what I did was I basically set the precision calculation to basically magnify the volatility in the indexes. So at some point it was just a dial. I could just dial it up, dial it down, dial up the volatility, dial down the volatility. And I knew that rates of return in the late 90s for a lot of these product types were in like the 15 to 20% range. So basically that's all I had to do was dial the precision calculation to get the amplitudes of the returns to match the marketplace based off experience. Do those look like indexes? Do those look like cycles?
Yeah.
Do real estate go in cycles?
Yeah.
Is real estate pricing cycles highly correlated to the business cycle?
Yeah.
Yeah, absolutely. So that was just another macro validation. So then everybody said, okay, now that you got the indexes, now you got to back test it. You got to run the macro factors. So the national index I ran against industrial production because I had it on a monthly basis and non-farm employment. So you could see that the indexes were highly correlated to the macro factors. This is an APT model, basically. Basically an APT model. Okay. So then the results were pretty interesting too. Overall, the indexes appear to lead the troughs and lag the peaks in the overall business cycle. That was the major takeaway, is when the real estate market starts to degrade and decelerate, pricing collapses very quickly, and then the economy bottoms after that. So pricing is forward-looking. Same things happen with stocks too. Stocks are forward-looking, so stock prices are always going to lead the trough. They're going to lead the downturn. Same thing with real estate prices, and then the economy is going to go into a recession. So you can use the real estate indexes and you can use stock prices to predict where the economy is going to go because they're leading. And we were able to find that, we were able to show that actually the indexes led the trough in the market by about 11 months. Okay, and it was coincident. I did two different time periods, 2 different recession periods. Did you have a question, Matt?
Yeah, I don't know if this is a good question or not, but when you're going into a recession, all the stocks are falling. What is the economy that isn't stocks? You know what I mean? So like.
The ones that aren't going to move as fast and probably aren't going to go down as far are consumer durables. You know, those are defensive stocks. But the way to look at it is that the reason why the stock prices go down so quickly is embedded in the Gordon growth model. Because you're always forecasting CFO T+1 in the next period divided by I minus G. Right? Is going to give you the value of the real estate or the stocks. So if G is decelerating pretty quickly, then the values are going to go down. So this is the #1 factor. So it's the expectations of cash flow growth rates that really drive real estate and stock prices down quicker than the overall economy. And the economy just lags. Okay. So what I did was I went back, again, APT. I basically looked at economic factors against the real estate price indexes, and then ran the adjusted R-squares and the T statistics, and basically identified the factors that had strong or moderate correlation with the indexes. Because what I wanted to do was say, okay, the indexes are, they track real estate, 1. 2, they're tradable indexes. 3, if you analysts build these models based off these recommended economic factors, you can forecast where the index is going to go in the future. Is that important? To build econometric models where you can forecast the index direction? Yeah, because if I can forecast that the index levels are going to go down, then what can I do? if I work for Goldman Sachs and my analysts are saying these real estate indexes are gonna go down, what would be my recommendation?
Short 'em.
Yep, exactly. We'd be shorting ETFs, shorting the REIT stocks. We would be writing forwards, writing futures, buying puts on futures, writing calls on futures. I would be making recommendations to the proprietary derivative desk,
So like the Big Short.
like the Big Short. Or in the other opposite direction, if I think they're gonna go up. Can I buy a national portfolio of real estate? Can I? It's around $50 trillion. So can I replicate the market by buying the underlying asset? No. But if I'm an institutional investor and I have an allocation for a national portfolio or some kind of replicating portfolio, couldn't I take the $50 billion or the $5 billion and buy forwards and futures, buy forward contracts? And I think the prices are gonna go up over the next 2 years. Could I enter into a 2-year forward contract and gain the exposure?
Yeah.
Yeah. And it's gonna take me 5 years to buy a $5 billion portfolio of real estate, but I can get exposure to the real estate market via the derivatives, via the indexes. And if this market was established and liquid, it would have been a huge solution for institutional investors to deploy capital strategically during time periods where there wasn't enough liquidity in the market. They could buy into the derivatives, gain the exposure for 2 years, and then as the assets became available, the tangible assets, they would liquidate the derivative contracts and buy the underlying asset, or buy into a commingled fund. So the derivatives were also a cash management tool also, or they would have been. And then the question was, well, how do your indices perform against other indices, real estate indexes? Well, theoretically, your index should be correlated to other real estate indexes if your index actually measures the real estate market. So what I did was I basically benchmarked our index against the other indices that I could find, and is there correlation?
Yeah.
Yeah, absolutely, so it's positive. So that was just another verification, validation, of our indices, that yes, they are correlated with the other indices, and yes, we do measure the real estate market. Okay. And then lastly, the property derivatives products. At this time, the global market for real estate, the underlying was about 15 trillion. It's about probably around 20 or 25 trillion currently. In the U.S. Market for commercial real estate is not 5.3, it's about 8 trillion. But even at this time, the derivatives market was huge and it was growing. So we were going to try to piggyback on the derivatives trading that was going on. And there was huge trillions of dollars in bank loans that were sitting in commercial mortgage-backed securities. So we could tie our derivatives and our indices to these major asset classes. And I would say that real estate is the last asset class that does not have tradable indices and derivative contracts. It's one of the biggest asset classes with no derivative contracts and no tradable indices, which is amazing to me. That nobody's ever come back over the last 10 years to try to replicate this solution. And then real estate went through multiple S-curves. In the 60s and 70s, you saw new products come out, REITs and limited partnerships. By the 1980s, there was basically closed-end and open-end commingled funds that were designed for institutional investors. In the 90s and 2000 periods, commercial mortgage-backed securities and REITs were fully adopted by not only retail but also institutional clients. And I was hoping that the property derivatives and the structuring of the derivatives to create synthetic products would have been the next S-curve in product development, really institutional market development. And then the same thing, property derivatives were in the innovator stage. I thought for sure we were going to go into the early majority phase. Just like REITs and CMBS were already fully adopted. Closed-end mutual funds and REITs and CMBS were also late majority at that time. And so I was looking for case studies and other new products that had been developed to try to track where this market was going so that we could forecast what our revenue stream was going to be. So I overlaid basically the adoption of these property derivatives, pulled out maybe a 1% market share for us, and then figured out, was able to predict what we thought our revenue stream would be for S&P and Schwab, based on the adoption of these derivative contracts. And the contracts are amazing. I mean, they meet a lot of the needs for the clients. They're highly liquid. You could use them to hedge off market risk. Very low transaction costs, especially when they were developed. They only had property risk only because they were only real estate. You could execute on the derivative trades, particularly if they were over the counter. Exchange-based on the two commodity exchanges. And I believe that you could actually add alpha if you knew how to trade these things correctly. You were looking for price anomalies. Who would use these contracts? Institutional investors. Large portfolio owners of real estate, REITs, commercial mortgage-backed securities. Lenders that were basically underwriting large commercial loans, maybe even sitting on portfolios of commercial loans. Oh, the best was foreign investors. Foreign investors are limited. They cannot own real estate in the United States, particularly foreign pension funds. Foreign pension funds cannot own real estate in fee in the United States, but they could have participated in the trading and market making in the derivative contracts. So it would have circumvented one of the legal impediments of foreign capital investment in the United States. Real estate portfolio managers could use the derivative contracts to hedge off market risk. Speculators could also trade in these contracts, particularly the exchange-based products, creating liquidity in those markets and forward pricing. And high net worth individuals would also participate in this market, not only from a trading standpoint, but also those who held real estate assets in their portfolio. They could hedge off their real estate risk. And then there's your typical contracts. The contracts, derivative contracts had already been created. So the standard contracts were already out there. The question was, what was the index and what was the underlying asset that was backing the indexes? And then if you calculated the value at risk within maybe your mortgage portfolio or your commercial mortgage-backed securities portfolio, that would be the portion within your portfolio that was susceptible to market risk, and you could hedge off that exposure. And this would also probably play well with the regulators too, knowing that you had derivative contracts in place to hedge off the market risk. The regulators would look favorably at you. And here's the typical swap contract. So you have party A, party B. They want to invest $100 million in a swap contract. It's going to be the $100 million times the total return, because you're swapping returns, real estate returns for LIBOR plus some spread, so some risk spread on top of the LIBOR. So it's basically floating for floating, is what you're doing. We could have done floating for fixed in these. I could have also designed contracts where we were swapping retail returns for office returns, because maybe one of the investors had huge exposures to the office market and was underallocated in retail. Well, they could swap off the office return in return for the retail return and diversify the portfolio through the swap contract. And then obviously once the swap market was established, option contracts could be designed swaptions on these swap contracts could have also been developed. And then here's your standard contract on the Chicago Mercantile Exchange. You have the contract multiplier, which is 250 times the index value is going to give you the amount of money that you would put up to buy that exposure, that long exposure. If you're doing a short on the index, if you're writing a futures contract, you would receive the 37,500. So this is all standard contracts. So the strategies that would be available to you, with risk management, you could do property type, regions, you could lock in your gains, hedge off the risk. You could use the contracts for speculation. So lastly, what the research basically did was to lay out a comprehensive modern institutional real estate portfolio management program based on modern and postmodern real estate portfolio theory and its applications. Basically, any questions on that? So I just wanted you to see, for those of you who have been with me over the last couple of years, a lot of the stuff that I learned in that time period I brought into the classroom for application purposes. So you're learning basically the same stuff. This stuff's not in the book, right? You would have had to have done it to do it, okay? And I lucked out because I was able to write up the research and then use the research in the dissertation, and then to be able to publish the dissertation to get the doctorate degree. So it was, I lucked out. Because if I would have published the dissertation 4 years earlier, I wouldn't have been able to do it. But since I procrastinated and then went and did all this research, then I waited 5 years after I was laid off. And so I had access to the intellectual property because the 5-year statute of limitations were over. So I basically had access to the IP. And then I called up Schwab, I called up S&P, I called up the Chicago Merck. There was people still there from when I had developed it. I said, can I use the documentation and the research in my dissertation? They said yes. I had to send them to S&P. I had to send the documentation to the CME and to Schwab to go through their legal departments. All their legal departments basically said, yes, you can use the IP, you can use the research, you can publish it in your dissertation. So I wouldn't get accused of plagiarism. So I wanted to make sure that they signed off on it before I published it, so I wouldn't get sued. Okay. So I have 5 minutes, so why don't you guys give me an update on where you are in the